Welcome to This Explainer. Today, we're going to unravel one of the most bizarre, honestly kind of counterintuitive mysteries in all of modern finance. Have you ever looked at the news, seen just absolute global chaos, conflict, skyrocketing geopolitical tension, and then you look at your portfolio only to see the markets hitting all-time highs? I mean, it literally doesn't seem to make any sense. But today, we're going to break down exactly why this happens. And fair warning, it's absolutely going to change how you view the entire modern financial system.
So, let's dive right into this core question, because there is a massive, glaring disconnect between the terrifying global headlines we read and the confusing reality of an exploding stock market. Common sense tells us that markets hate uncertainty, right? And war is the ultimate uncertainty. Yet, time and time again, stocks seem to completely ignore global conflicts. To understand why, we really have to look past the mainstream financial headlines and dig into the actual mechanical plumbing of what's happening under the hood on Wall Street.
Okay, Section 1, the relief rally illusion.
So, let's look at April 7th. A ceasefire was announced, and the media immediately spun this massive relief rally narrative. But if we actually look at the timeline, it tells a totally different story. Back on February 28th, joint airstrikes were launched on Iran, and the Strait of Hormuz was completely shut down. By the end of March, the market was bleeding. I mean, it was in its worst 5-week losing streak in nearly 4 years, with the S&P down almost 9%. But then, on the evening of April 7th, a ceasefire is announced. And the very next morning, boom, the market explodes. The Dow climbs over 300 points, marking its best single day in almost a year. Over 400 names in the S&P finished in the green. It looked like an absolute textbook celebration of world peace.
But here is the crazy part. While the media was celebrating peace, maritime intelligence firm Windward, who uses AI to track digital GPS signals and satellite imagery, found something completely different. By midday of the so-called ceasefire, they detected only 5 outbound carriers moving through the Strait of Hormuz. Guys, that is a 96% decrease in maritime traffic compared to the pre-war baseline. Think about that for a second. How on earth can there be a relief rally based on world peace if the ships on the ground, or, well, in the water I should say, prove there's actually zero world peace?
Which brings us to Section 2, Peak Wall Street Panic.
To uncover what actually moved the markets, we have to throw out that fake relief rally narrative completely and examine how utterly terrified Wall Street was just weeks prior. Because, the secret to explosive upward moves usually starts with extreme downward panic. Take commodity analyst Rory Johnston, for example. He noted that analysts weren't just a little worried, they were terrified. They were modeling doomsday scenarios where 15 million barrels a day of global demand would just vanish, potentially driving oil to $250 or even $300 a barrel. He pointed out that in a scenario like that, a recession is way too light a term. We'd literally be talking about something depressionary.
Everyone was overwhelmingly bearish, and the hard data from Goldman Sachs' prime brokerage desk proves it wasn't just talk. Hedge funds weren't just sitting on the sidelines biting their nails, they were actively betting against the market. Goldman saw the largest hedge fund selling since April 2020. These funds were dangerously leveraged, with gross leverage sitting at over 300%, which is near an all-time high. And their short exposure to macro ETFs like the S&P and the Nasdaq, it hit the highest levels since the pandemic. The entire street was tilted heavily in one direction, heavily leveraged and heavily short. Basically, they built a giant trap for themselves.
Let's look at Section 3, the 3 falling dominoes.
You see, human emotion and a collective sigh of relief didn't cause that massive rally on April 8th. No way. It was a rapid-fire sequence of mechanical dominoes falling one right after the other. Our first domino is the classic short squeeze. When you have a market where literally everyone is highly leveraged and betting on the price to go down, any slight upward surprise acts like a match in a powder keg, and that violently reversed Wall Street's massive negative positioning.
It's a short seller's ultimate nightmare, and it creates this unstoppable mechanical upward spiral. Here's how it works. You borrow and sell shares, hoping the price drops. But if a headline, like a fake ceasefire, makes the price unexpectedly tick up, you start taking losses. Suddenly, your broker issues a margin call, forcing you to buy back those shares immediately at market price. Your forced buying pushes the price up even higher, which then triggers margin calls for the next guy, who also has to buy. That's the first domino right there. Just a purely mechanical wave of forced buying.
Then the second domino falls with the algorithms, specifically CTAs, or commodity trading advisors. These are systematic trading firms that don't watch the news, they don't care about geopolitics, and they definitely don't care about ceasefires. They just blindly follow price trends.
Going into April, Goldman reported these CTAs were sitting on a massive $30 billion net short position. But the second that short squeeze pushed the S&P past certain technical trigger levels, their models mechanically flipped. They didn't just go neutral, they aggressively went long, buying $86 billion in equities in just 5 days. That's one of the top 5 fastest buying sprees in recorded history, and it was entirely executed by machines.
And the third domino? That's the options market. The financial data platform Spot Gamma flagged that dealers heading into this period were stuck in a negative gamma regime. Simply put, when customers are buying options, the dealers on the other side of the trade have to keep their own books balanced, or delta neutral. In a negative gamma environment, as the price goes up, these dealers are systematically forced to buy the underlying stock to hedge their risk. Price goes up, dealers buy more. Price goes up more, dealers buy even more. It's a massive, mechanical, pro-cyclical loop that just feeds on itself.
Now for Section 4, the new market machine.
A short squeeze, an algorithmic flip, and mechanical dealer hedging. Those 3 mechanical dominoes are the fundamental reality of how our financial system operates today. We saw similar mechanics play out in December 2018 and again in August 2024. We really have to let go of this nostalgic idea of the old market. I mean, we all love the idea of portfolio managers carefully reading earnings reports, modeling cash flows, and debating over coffee what a company is fundamentally worth based on world events. But today, that world of careful human valuation is practically gone. The new market is entirely dominated by algorithms, passive money, and options dealers reacting in milliseconds. Just look at the numbers. A staggering 63% of all U.S. stock funds, which represents over $13 trillion, are now held by passive indexers. This is totally blind money. It doesn't care if Apple had a good quarter or if there's a war overseas. It just buys the index on autopilot. And because these funds are market cap weighted, the bigger a company gets, the more they automatically buy. That default allocation is exactly how the Magnificent 7 tech stocks have grown to make up over 33% of the entire S&P 500.
And what about the remaining active funds? Well, they've consolidated into a handful of mega, multi-strategy hedge funds, places like Millennium, Citadel, and Point72. They are running incredibly hot, utilizing 4 to 8x leverage. Because of that extreme leverage, they operate on strict mathematical drawdown rules. When they hit a loss limit, they don't sit around in a conference room and debate whether the geopolitical news is actually bad. They are forced to sell immediately, no questions asked.
And underneath it all, accelerating everything is the options market. A staggering 63% of all S&P trading volume is now made up of same-day expiration options. On peak days, we are seeing over $2 trillion of notional value change hands in a single session. That is just an astronomical amount of money. And every single one of those options forces a dealer on the other side to hedge in real time, completely divorced from any sort of fundamental value.
So the stock market of finding undervalued companies and holding them long-term, yeah, that's been largely replaced. What's left is a giant hyperfast feedback loop of passive funds, automated models, and algorithmic dealers, all blindly reacting to one another. I'll leave you with this provocative thought at the end of our explainer. If the market is essentially an unthinking machine reacting to positioning and leverage and completely ignoring real-world data like empty shipping lanes, then the daily news headlines are really just the stories we tell ourselves to rationalize the chaos. So the next time you see stocks ripping higher while the world burns, ask yourself, who or what is actually pricing the market today?